Lots of talk, lots of posturing, lots of sound bites, but so far not a lot of action. If you think this sounds like our elected officials in Washington, D.C., you're not alone. Hi, my name is Joseph Eschleman, and I am the president of Towerpoint Wealth, a boutique wealth management firm headquartered here in downtown Sacramento. In this video, put your seatbelt on, because not only am I going to briefly discuss the details surrounding these two major infrastructure bills we keep hearing about, but perhaps more importantly to investors like yourself, I'm also going to delineate what federal income tax increases may occur if one or both of these massive bills pass. Now, legislators are taking a two-step approach in their efforts to pass President Biden's ambitious jobs and infrastructure program. Some of it Republican-friendly and some of it Democrat-friendly. This two-track plan, some might say scheme, to pass this legislation works as follows. Put the GOP-friendly items in a $1.2 trillion bipartisan infrastructure bill that could pass on a bipartisan basis, and then put the rest in a much larger $3.5 trillion infrastructure bill that would attempt to pass on a party line vote via what is known as budget reconciliation, which only requires a simple majority to pass it. Now, the $1.2 trillion Infrastructure Investment and Jobs Act already passed the Senate by a vote of 69 to 30 back on August the 10th. Now, what exactly is it? So the bipartisan infrastructure bill focuses on building roads, building bridges, electric vehicle infrastructure, and railroads. According to the White House, this deal marks the largest federal investment in public transit ever, and also the largest investment in passenger rail since the creation of Amtrak. Additionally, this bipartisan infrastructure bill marks the single largest dedicated bridge investment since the construction of the interstate highway system. And, not to be outdone, it marks the largest investment in clean drinking water and wastewater in infrastructure American history. To be clear, this is a truly monumental measure with an equally monumental 13-digit price tag. However, this bipartisan infrastructure bill cannot become law until it also passes the House of Representatives. And that's where things start to become, well, a little tricky. Speaker of the House, Nancy Pelosi, promised that the House will vote on the bipartisan infrastructure bill today, Thursday, September 30th, but another delay is likely. Why? Well, Pelosi faces some significant pressure from the progressive Democrats who say that they will not support the skinny $1.2 trillion bipartisan infrastructure bill unless the bigger $3.5 trillion infrastructure bill, which focuses on human infrastructure and social spending, such as climate change mitigation, increased childcare funding, and healthcare expansions, moves ahead as well at the same time. It truly is amazing that we live in a world where spending $1.2 trillion on the bipartisan infrastructure bill is considered skinny. But I guess it is skinny when compared to the $3.5 trillion infrastructure bill the progressives would like as well. Now, financing social programs such as universal pre-kindergarten, extended childcare, and an expansion of health insurance coverage provided under Obamacare, the $3.5 trillion infrastructure bill, which is known as the American Families Plan, as I said, represents the largest expansion of federal spending since the New Deal. And with this price tag comes the concurrent federal income tax increases that fund it. I know they're on your mind, so let's talk about these potential increases next. Number 1, higher federal tax rates. The American Families Plan will increase marginal ordinary income tax rates from 37% for the highest tax bracket to 39.6%, which restores the pre-Trump, pre-Tax Cuts and Jobs Act rates. There will also be a 3% excise tax on any income in excess of $5 million a year. Number 2, higher corporate tax rates. The corporate tax rate is set to increase from 21% to 26.5%, with a minimum tax of 16.5% on offshore earnings. Number 3, higher capital gains tax rates. The marginal capital gains tax rate for those with incomes higher than $400,000 will increase from 20% to 25% and will be retroactive to September 13th of this year. Number 4, the elimination of the step-up in cost basis upon death. And number 5, limitations on popular tax planning vehicles such as tax-free Section 1031 real estate exchanges and IDC deductions. Additionally, revealed in the $3.5 trillion infrastructure bill details, Roth IRA conversions, something we focused on here at Towerpoint Wealth, would be eliminated for taxpayers with incomes over $450,000 for joint taxpayers and for single taxpayers with incomes over $400,000. However, this would only be effective after December 31st of 2031, so we have a lot of time to plan. Now, anyone who's not eligible to directly contribute to a Roth IRA is able to do a backdoor Roth by making a contribution to a non-deductible IRA and then immediately roll it over to a Roth IRA. Well, this backdoor option is set to be banned for all income levels. Lastly, very large IRAs are also in the crosshairs. IRAs that have a total value of $10 million or more will be prohibited, and IRAs and 401ks in excess of $10 million will have required distributions equal to half the amount over $10 million. If the retirement account is over $20 million, then everything over that number must come out immediately. All of these rules are not direct federal income tax increases, but they do get the job done when raising revenue is in fact the goal. To be clear, it is unknown whether the spending associated with the $3.5 trillion infrastructure bill will remain at that elevated level. Here at Towerpoint Wealth, we feel that the final size of the second infrastructure bill, if an agreement can be reached, will end up only being about 40% of that original $3.5 trillion size, somewhere in the neighborhood of 1.2 to 1.5 trillion. Importantly, and regardless of how things shake out, here at Towerpoint Wealth, we sincerely believe 3 things. 1, taxes will be higher over the next few years, perhaps in a very significant fashion, as early as January of next year. 2, there is a very reasonable probability that trillions of dollars will soon be spent by our federal government via these 2 infrastructure bills. And 3, the next 3 months represent the most important tax planning months in recent years, as the potential federal income tax increases mentioned could be effective as early as January 1st of next year. Now, typically the markets like stimulus and federal spending, which we certainly could see with the massive amounts of spending that would occur with the passage of the $1.2 trillion bipartisan infrastructure bill, as well as the $3.5 trillion infrastructure bill. At the same time, the markets historically don't like federal income tax increases very much. Think things are unsettled now? Well, guess what happens when you add in all of these extra ingredients and variables over the next 2 months. At Towerpoint Wealth, we feel safe in saying that you should expect additional uncertainty and volatility through at least Thanksgiving, if not through the end of 2021. Now, what we have discussed today are things that are, for the most part, out of our control. And at Towerpoint Wealth, our focus and our energy will always be on things that we do have control over. While we can't direct the wind, we can make some adjustments to the sails. And as mentioned, there are clear financial, investment, and tax planning opportunities for the fourth quarter of this year. It could be advisable to accelerate income this year in 2021 and defer tax deductions into future years to leverage today's low taxes and minimize the effect of potential future income tax increases. Or it could be beneficial to utilize a partial or a full Roth IRA conversion this year, potentially before it goes away. Additionally, looking more closely at gifting strategies, such as using a donor-advised fund, or DAF for short, while accelerating or bunching your charitable contributions to get the standard deduction in 2021 might be worth your consideration. Here at Towerpoint Wealth, and unlike advisors at the major Wall Street firms, we are a legal fiduciary to you. And we have a legal obligation to act in your best interests 100% of the time. We'd like to get to know you and have you get to know us. So let's talk. Call us at 916-405-9140 or email us at info@towerpointwealth.com to discuss your circumstances further. Thank you for watching this video.